is that you actually set up a study calendar. It'll kind of be a roadmap for you. Then you should study every chapter. I know it might seem daunting, but it's really not. Take it chapter by chapter. Read the material. You want to then study by using the quizzes per topic. Good way to test yourself to make sure that you're understanding the terms and concepts as you move through the material. You should be scoring in the 70 percentile or better on these. Your next step along the path would be to simulate your actual exam, and you need to be scoring in the 80s or even higher at this point. It's a good indication that you're doing well. Then you can do your focused review as you're getting closer to your real exam date. Again, then simulate your exam and review the score sheet after every exam, and to look at anything that you might need to put some additional time in on studying or review. Then take the guarantee exam, and you need to score at least 80% on that particular exam. Then set up and go and pass that scheduled exam. If you do this, you are following the path to success. Study tips. Always take notes. Everything means more and gives you a clearer understanding if you've taken your own personal notes on some concepts or terms. Be sure and pay attention to small details, like the tiny words, is not, except, incorrect, those types of things. Be careful. Read those questions carefully. Memorize the glossary. Those terms can really, really help as you work your way through the exams. Make reference sheets. Again, anything that's going to help you solidify the details in your mind for exam day. And then keep fresh information. You study up until the day before your exam. Never take a practice exam the day of your exam. That's going to stress your brain too much. So keep a kind of a steady rhythm as you prepare, and you should be successful. Exam tips. Read the test tutorial and then take the practice questions. Next, you want to read the questions and all of the answers. Don't get halfway through an answer and think, oh, I know this is the right one. Make sure you read everything completely, because of those little small words, is not, except, that can change the right answer. Eliminate the answers that you know are absolutely wrong, and then don't let unfamiliar terms throw you off. If you didn't study a particular term and it just doesn't ring any bells, it probably means that it's a wrong answer. Pay attention to words that can change the question, such as is not, except, or incorrect. Read carefully and slowly. I know it's hard to do when you're nervous, but slow down. Go with your first response. Kind of your gut reaction is usually pretty accurate. Pace yourself. Don't start just running through the questions as fast as you can. Yes, you know they're timed, but read them slow enough that you're able to take in all the details. Know what to expect. The questions are multiple choice, and a lot of times there'll be something you might want to just read the sentence and you just have to complete it to find the right answer. Slow down. Be careful. Insurance basically is the transfer of risk. Types of risk. There are two types of risk. Pure risk and speculative risk. Pure risk is the type of risk that you can insure. It also means that it's something that you cannot possibly have a gain from entering into that kind of risk. Whereas speculative risk, you could have a loss or a gain. Think of gambling in Las Vegas. Can't find an insurance policy for that. It's speculative. Let's talk about types of hazards. There are physical hazards. They are something that causes or is a reason for a loss. Like you've been smoking since you were 14. Insurance, basically, is the transfer of risk. Types of risk. There are two types of risk: pure risk and speculative risk. Pure risk is the type of risk that you can insure. It also means that it's something that you cannot possibly have a gain from entering into that kind of risk. Whereas speculative risk, you could have a loss or a gain. Think of gambling in Las Vegas. Can't buy an insurance policy for that. It's speculative. Let's talk about types of hazards. There are physical hazards. They are something that causes or is a reason for a loss. Like, you've been smoking since you were 14 years old. That's definitely a hazard. Or, I lied on my insurance application. That's a moral hazard. You're not telling the truth. All different kinds of hazards. Hazards are conditions that increase the probability of an insured having a loss. A peril is a cause of a loss. And what is a loss exactly in and of itself? A loss is a reduction in value. It's something that would cause you to file a claim with your insurance company. And by having insurance, you transfer that risk of loss. It's shared with the insurance company, and they give you the protection of the insurance policy to cover a possible loss. Handling risk. There's several things you can do. For example, you can totally avoid something in order to stay away from the risk. Like, you don't want to have a car accident, so you never drive a car, you never get in a car. That would be avoiding it. Another term is retention. Retention is when you actually self-insure, if you would. You assume all of the costs of any risks that you might encounter. You can reduce risk. For example, you're afraid of having car accidents, so maybe you don't drive on the interstates and you only drive on surface roads. That would be reducing your risk of a possible car accident. And then there's transferring risk. When you take out insurance, you are transferring the risk from yourself solely to the insurance company. Insurable risk. There's several items that come under this topic. First of all, the risk has to be due to chance. It's not something you plan, okay? It has to be definite and measurable. It has to be statistically predictable so that the actuaries can work with that condition and properly price products, for example. Cannot be catastrophic, meaning hugely impactful, and it must randomly be selected, and you have large loss exposure. Types of insurers. Now remember, the word insurers means insurance companies. There's different ownerships. You have stock insurance companies and mutual insurance companies. Stock insurance companies issue what are called non-participating policies. They are owned by the stockholders. And when a stock insurance company declares a dividend, you have to own shares of stock in the company to get that dividend, not a policy. Now with mutual insurance companies, they issue what are called participating policies. Those are owned by the policy owners. They pay dividends, and the dividends are considered to be unused premium. Types of insurers as it relates to their authority. An admitted or authorized insurance provider or insurance company, they receive what is called a certificate of authority from the state. That allows them to do insurance business in that particular state. Non-admitted or unauthorized insurance company does not have that certificate of authority, which means they're prohibited from transacting any business of insurance in that particular state. Let's talk about some different types of insurers or insurance companies. It relates to their domicile, where their home offices are located. You're considered to be a domestic insurer if your home office is located in this state. You're considered to be a foreign insurer if your home office is in some other state. And you're also then known as an alien insurer if your home office is in another country. like, say, Canada or England. The law of agency. First of all, agents represent the insurer, the insurance company. Knowledge of the agent is considered to be the knowledge of the insurer. The insurer is responsible for the agent's actions. You represent that insurance company, and a payment to the agent is considered to be a payment to the insurer, the insurance company. An agent has different types of authority. The first one is express authority. Whenever you see the word express, it means written. Think of your contract with the insurance company. Implied. Implied authority means it's not written down, but people assume you have the authority. For example, you sit down with a client and you take an application with them. They consider you have the authority to do that. And then there's apparent or perceived authority based on the principles, actions, or words. Again, customers will come to you and ask you questions about things, maybe things that you really don't have the authority to answer, but they think that apparently you do because you represent the company. You have to be careful to not overstep your bounds with apparent authority. What makes up a legal contract? First of all, you actually have the agreement. The offer is the application completed by the proposed insured. The acceptance is by the insurance company when they issue the policy. Then you have consideration. The applicant's consideration is the representations or answers that they put on the application, and then also the premium check. The insurer pays claims as needed. Number 3, competent parties, meaning if you enter into a contract, you have to be of legal age, you have to be mentally competent, and you can't be under the influence of drugs or alcohol, for example. And all contracts must have a legal purpose, meaning you're not doing anything that is against public policy. Consideration. An insurance company consideration is their promise to pay a claim. The policy owner or the insured's consideration is their statements on the application and the premium payment that they make. Let's talk about some different aspects of a contract. First of all, they're aleatory, meaning unequal exchange. You could make one premium payment and have a full death benefit paid to your beneficiary if you would die the next day. And that death benefit is going to be much more than the one premium that you paid in. So they're unequal. They're personal. They're between the insurance company, the insurer, and the insured. The contracts adhere or follow the doctrine of adhesion, meaning you have to take it or leave it. You don't get to change the verbiage within a contract. It's written by the insurance company. They're unilateral. The term unilateral means one-sided. The insurance company is on the hook to pay the claim. That's something they cannot get out of. That's their promise. You, as the insured, could cancel the policy at any time. And they're conditional. Certain conditions need to be met. On life insurance, for example, one of the big conditions is you have to go through underwriting, maybe have a physical done and things like that. Warranties. They are an absolutely true, 100% true statement. Breaches of warranties can void a policy out completely. And then there's representations. Representations are the answers that insureds give on an application. They're considered to be the truth to the best of their knowledge at the time they write that information on the application. Let's talk about some uses of life insurance. There's several personal things that you can do with life insurance. For example, You could buy insurance for survivor protection. Probably the people you name as beneficiaries. You're wanting to take care of the people that you're leaving behind. It can be used to create an estate. If you're the beneficiary of a federal income tax-free death benefit, all of a sudden you have an estate. You have cash. You can conserve an estate by using it as a planning tool for your heirs. Cash accumulation. If it's a cash accumulating policy, there's a section of the policy that's going to grow over time, and you have liquidity that can be met by accessing the cash value of those cash value policies. Let's talk about key person insurance. It's a type of business insurance. It's where you insure a valuable employee, maybe your top salesperson or someone like that, someone who has a huge impact on the success of your business. The business would actually apply for the policy on behalf of that key person. They would own the policy, they would be the premium payer, and they would also be the beneficiary. So if that key person were to die prematurely, the death benefit would pay to the company, and the company could use those dollars to perhaps search for a replacement for that key employee. Business insurance can also be used to fund a buy-sell agreement or a business continuation plan. Business partners will buy policies on all the other partners, so they cross-purchase the policies among themselves. And again, it's to protect the business should one of the partners die prematurely. In order to take out a policy, you must be able to prove insurable interest at the time you take out the policy. What does insurable interest mean? It means there has to be a valid reason for you to be taking out this insurance policy. You always have a valid reason to take insurance out on yourself. So you are always important and can insure yourself. You also can take insurance out on family members, including your spouse, your children, persons who mean a lot to you. And then you also can insure your business or your business partners. So you always have insurable interest if you insure yourself, your family, or business connections. When you insure a family member, it's sometimes referred to as a blood relative. You have to have a blood relationship in order to make that insurable interest apply, which you would have blood relationships on yourself, of course. You can always insure yourself. You would have that same kind of relationship between your spouses and, of course, between parents and children. Note that sometimes the distant relatives might not qualify under this description. And then your business relationships, that would be between business partners. It would be employees that are insured by their employers. A lot of us have coverage, that way. And also remember, though, that employees can't insure the employer. Let's talk about purchasing life insurance. The policy owner is the person who pays the premium to the insurance company. The policy owner owns or controls the policy. The insurance company issues the policy to the policy owner, and should there be a claim, they will pay the claim to the designated beneficiaries. And the beneficiary is the person or persons who receives the benefit paid by the insurance company. Let's talk about the process of issuing an insurance policy. It starts out with you, the agent. You do a solicitation to a potential client and do a sales presentation explaining the product, and they agree to buy that product. So you sit down, help them complete the application, have them issue a premium check for you, and you get ready and you're going to send that into your home office. And while you're doing all that process, you could call yourself the field underwriter. That's really what you are. You are the eyes and ears of the insurance company when you're taking an application. You send all that paperwork into the home office, and it will go through the underwriting process. It'll be reviewed, and if the insurance company decides that it is a risk they're willing to take on, then they're going to determine the proper premium based on the application and the client's health and several other factors. Then the policy is issued and sent to you, usually as the agent, and then you deliver it to the customer. Let's talk about the parts of an application. Part 1 are the general questions on an application. The Part 2 section is always the section about your health history and medical questions. And the third piece of documentation is called the agent's report. You complete this, letting the underwriter know any pertinent information or observations that you have about the proposed insured. Then, part of that application is also a signature section. You always have to sign an application as the agent, and the applicant or owner of the policy has to sign as well. You cannot make any changes on an application once those signatures are in place. That would not be the right thing to do. And you must make certain that everything is answered completely on an application. Because if you skip something, you send it in, the application will be returned and you'll have to get it answered, and it just delays the whole process. Always make sure you review the paperwork for all signatures and all complete information. Let's talk about receipts. You have a receipt that you give a customer when they write a check and send it in along with the application. There is a section on the application itself. It's kind of a perforated section along the bottom of a page, and you actually fill in the amount of the check that you took from them and you give it to the client. Now, would you give that receipt to them if they didn't write a premium check when you took the app? No, you would only give that when they send the check with the application. Then you have a conditional receipt. A conditional receipt states that the coverage will be effective as long as certain conditions are met. One of the most common conditions that has to be met is you have to go through the physical and be healthy enough for the coverage to be written. Classification of risks. There's several. There's preferred, standard, substandard, or a full decline. Let's talk about each of those. A preferred has the lowest risk and the best premiums. Everybody wants to be preferred. Not everybody is, though. Then there's standard. Standard just means average exposure to various kinds of risk, and you're covered at a standard premium. Substandard means that you are a higher risk for the insurance company, so your premiums are going to reflect that. They're going to be higher. And sometimes people are just maybe so unhealthy that they are a decline. The insurance company does not think that they can charge enough premium to mitigate the risk that you represent. Policy delivery. You deliver a policy. When you deliver a policy with a premium, that becomes the effective date, the date of that premium. If you deliver a policy without a premium, you deliver the policy and then you have to have an additional form signed. It's called a statement of continued good health. Your client is going to answer questions on this brief form that says, I am still in good health. I haven't been diagnosed with any dire diseases or anything like that since I completed the application. And then that statement of good health, the premium check that they give you upon delivery of that contract, equals the effective date of the contract. Term insurance. Let's talk about the different types of term insurance policies. You have increasing term, you have level term, and you have decreasing term. Now, with the increasing term, you have a death benefit that increases, but your premium stays level. On a level term, you have a level premium, and the death benefit stays level for a specified period of time. Then on decreasing term, again, the premium stays level, meaning it's the same, but the death benefit decreases. Annually renewable term. Sometimes it's referred to as yearly renewable term. It's the same policy. You have a face amount or death benefit that stays the same, but every year that you are a year older, your premium increases. Annually renewable term. Let's talk about term insurance. Some of the basic information. Term insurance is considered to be temporary coverage. It is the least expensive. It has no cash value, so it's considered to be pure protection. You pay a premium, you have a death benefit, nothing more. And it matures at death. There's 3 basic types. You have level, you have increasing, or you have decreasing term policies. The features, not too many, as I said, they're fairly kind of straightforward. You could have a renewable policy or one that could be convertible, meaning you could change it into a different type of policy. Let's talk about maybe some of the uses. They are going to give you the maximum protection for the lowest amount of premium. So they cost the least amount. Increasing term can be used for riders, or you add those on to other policies. And decreasing term is usually used to cover death. Think about it. Every time you make that motorcycle payment, you owe less than the month before. So you have a decreasing term policy. The death benefit decreases along with the amount of the loan that you owe. And when you pay off your loan, the policy is down to 0, and it is done on the exact same day that you pay off that loan. Cash value insurance is another name for whole life insurance. It means it covers you for your whole life, usually out to age 100. So you have permanent protection is another term that they use to describe whole life. You also have living benefits because whole life policies have cash value accrual, and you can access that during the life of the policy. At the end of the policy period, at age 100, your cash value will equal the face amount of the policy, and it is said to mature. Whole life insurance. Let's say you have a $100,000 death benefit, meaning that's what would be paid federal income tax free to your named beneficiary. You take it out at a younger age, let's say, just for example, 35 or 40, whatever, and you have coverage all the way to age 100 because it's a whole life policy, okay? So you pay a level premium, and over time, cash value starts to accrue. There's like a savings component. There's a monetary component in this policy. So the larger the cash value is, the less risk that the insurance company has to cover. Because should you die, they will use the cash value to offset how much money they have to come up with to meet that $100,000 death benefit that would have to be paid out to that designated beneficiary. Single premium whole life. It's just what it sounds like. You make one single large lump sum premium payment. The policy is a whole life policy, so you've paid it up at the very beginning, and you have coverage from that policy all the way to age 100. You only make one premium payment, and it's a large lump sum at the beginning. Different ways to purchase whole life insurance. There are several different approaches that you can take. For example, if you have a large lump sum of money, you could make a one-time premium payment. It would pay up a whole life policy all the way to age 100, and you only make that one payment. Maybe you decide to take some of your retirement money when you retire. You get it from your retirement plan, perhaps, and you go ahead and you take enough premium to take out a life insurance policy and pay it up to age 100, and you don't have to make any more premium payments. Or you could do what is called a limited pay. It means you don't have to pay every single year, but maybe you shorten up the premium payment. A lot of people, if they take a policy out, say maybe age 25, they'll want to pay it up at age 65. Well, how long is the coverage good for? It's whole life, so it goes all the way out to age 100. Why would you want to stop paying premiums at age 65? Because you retired. Maybe you're going to go on that fixed income and don't want to have to worry about premium payments during that time after you retire. So it's a perfect fit for many people. Or you could do something that they call straight whole life, And it means that you buy the policy at age 25, and every year you make a premium payment until you reach age 100 and the policy matures. It's up to you, whatever is going to work best with your lifestyle and your plans. Term insurance versus permanent or whole life insurance. Term insurance is always considered to be temporary. It's usually for just a specific period of time, not too many years down the road, because it becomes more expensive over time. And remember, term never has a cash value. Then you look at whole life. It is considered to be permanent insurance, and it will cover your life all the way to age 100. So you have what is called lifetime protection, and it will have a cash value that you can access if need be during the life of the policy. Universal life, you pay a premium into the policy, and it grows by using an interest rate that is assigned to the policy. So that's how your cash value grows over time. And then from that cash value, expenses flow out, and you can also take loans and withdrawals from that cash value. Universal life, options A and options B. With option A, you have a death benefit, and it pays out upon your death to your beneficiary, the stated death benefit of the policy. With option B, the death benefit, of course, pays out to the named beneficiary, but also the cash values are paid out as well. So, which one do you think might have a higher premium? Usually it's option B. Most typically chosen is option A, but they're both available. Variable life insurance. In order to sell this type of product, you have to have a life insurance license and also a securities registration, which means that you deal with the Department of Insurance as well as the SEC and FINRA because of it being a security. What makes a variable policy also a security? It's the fact that the separate accounts, which is where the money goes into the cash value and grows, it is used to purchase mutual funds. Those are securities. That's why you have to have the securities registration. So it's considered to be a security. There aren't guarantees to that cash value because it all depends how well the funds perform. So if they don't perform well, cash values, of course, will be negatively impacted. So no guarantees as to what the cash value might look like due to the fact that the market is variable, so therefore your separate accounts are going to have variable results. Joint life versus survivorship life. Joint life simply means that you have one insurance policy. It covers